Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Hey, everyone. Welcome to another episode of the Major League Real Estate Podcast. Someone had told me that I haven't been saying real estate recently, but just want to welcome everybody today. As you can see, my normal host is not here. Matt is currently on leave because he's had his first kiddo. Didn't happen on the podcast like we thought maybe it would. But I've got our CEO and founder at Hall CPA, Brandon, on board with us.
What's up, everyone? How's everyone doing? Thanks for tuning in and listening to yet another episode of the MLRE podcast. Happy to be here and happy to be a guest. What do we have today, Nate?
This is Brandon's return to the podcasting world, everybody. It's he's been taking a hiatus, and he's blessing us here. And so the last time we talked about 1031s and how it's kind of difficult for syndications to perform 1031s and make all that happen. But now what we're actually going to talk about is the drop and swap piece that we didn't get into last time. We mentioned it. We didn't get a chance to get into it. And actually, we have a court case, specifically a New York court case, but on how a successful drop and swap was defended. It's a super interesting case to get into. And what's really neat about it is that New York, while this case only applies to New York, right? So why even talk about it? Well, it essentially gave us a ton of federal sites. It gave us a ton of federal sites and citations because New York completely conforms to 1031 for their own state purposes. So it's going to be really interesting to dive through that and dive through the judge's reasoning and the taxpayers' reasoning on why they should be able to defend this. So super interesting. Brandon, have you dealt a lot with drop and swaps and seen a lot of drop and swaps through the firm?
We've seen a handful of them. I've not personally dealt with them to any major extent, but I've kind of sat on the sidelines as our team has been advising clients on it. We've actually seen there's a law firm out there, really brilliant guy, Matt Rappaport, who has done many presentations on this for our tax and legal summits that we've had historically every year. And his presentations are phenomenal because he just really breaks it down. But I guess if we can start somewhere, can you just explain what a drop and swap is?
Yeah, so that's a great question, Brandon. So actually, let me take one step back, right? And talk about 1031s. And 1031s, like we talked about last time, 1031s is basically you buy a piece of real estate, you exchange it for another piece of real estate, right? Long story short. The drop and swaps are a little different because you're doing it 90% of the time in a partnership. And what happens is, a partnership owns the entity 100%. And sometimes there's two other variations that happen. You have what's called a TIC interest, a tenants in common interest in the property that someone contributed in. They didn't necessarily contribute the property in, even though they did, but they put into the partnership their TIC interest that's now technically owned by the partnership, and so therefore it owns the entity. But what that means is you distribute the TIC interest out, and that allows individual partners to go their own ways and split up when they wind up doing 1031 exchanges down the road. So that's a drop and swap. So that's one way that you do it. Or the way that's less preferred by the IRS is you actually just distribute the interest to yourself without having a tick in the interest into whether it be an LLC or your personal name. You distribute it out to yourself, and then you go through the 1031 exchange. That second one is a lot more times beat up by the IRS. So it's a very complex transaction. It's not easy to execute and requires a lot of planning to actually move forward with.
Very interesting. And so what type of people really benefit from a drop and swap?
People who benefit from a drop and swap is always so it's whenever you have dissenters in a partnership, right? So you have anyone in a syndication that doesn't want to continue deferring their gain down the road and doesn't want to get into new real estate, and they want to go do their own venture. They want to go do their own thing, right? In this case, the Hadar Shamron case that we'll talk about here in a second, you had everybody who wanted to go their own separate ways and one partner who just didn't want to deal with real estate anymore. They wanted to have just put their money in different investments and move along without having to deal with real estate. So it's for people who want flexibility, I guess is what you'd say.
Okay. And the timing of the drop and swap matters as well. You can't, because we were just speaking with an attorney here locally in North Carolina about a unique thing that he's doing to handle this 1031 exchange in a big partnership issue. And he kind of brought it up too. The drop and swaps work great when what?
When you have time beforehand, right? When you have a couple of months, right? Is what you say. What's crazy about this case is they didn't do that and they still won.
Interesting. All right. Well, before we get into the case, I've got one more question for you. Do you know how much it costs to run a drop and swap? Like, I imagine the attorney fees. This is actually something I have not personally looked into, even though we've been kind of privy to some of this stuff. Maybe I should. But do you know how much it costs to run a drop and swap? I got to imagine it's pretty expensive.
I'd be shocked if it's not, and if it's not 10 plus thousands of dollars. I'd be shocked. I'd be shocked if that, like if you're getting $10,000, you're probably getting a deal, and it's probably not the best attorney in the world who's going to help you out with it.
Yeah. Okay.
It's not a cheap transaction. And as we'll talk about the case, right? The reason why is because you need lots of paper trails and lots of documentation. Attorneys are great at making that. And hey, in the age of AI, I'm not sure I trust AI to catch all the things that an attorney is supposed to when we do this type of stuff. So just an FYI piece, if you want to do a drop and swap, don't have AI have AI advise you, but I would go to the attorney and take care of all that stuff too.
Perfect. You want to get into the case?
Yeah, let's get into the case. So we have called Upwest Co. Basically, Upwest Co. invested way long ago, back in the 80s, into this apartment building in New York. And so obviously, you invest in the 80s, you sell, and you try to sell in 2013, you've got a pretty massive gain between now and then, right? It's purchased for $975,000 in New York. Think about a big multi-apartment complex and what it's worth now. They were able to sell it for $56 million. That's a pretty sweet appreciation, in my opinion. They've fully depreciated the property, all that stuff. They're now in second, third generation territory. And so these original investors who got together are now basically going, okay, we've got insane gain on this property. We all want to kind of go our separate ways. We don't necessarily want to be tied together any longer. And then you had Hadar and Shamran, who wanted to stay in real estate, but you had the other person, SWB, who did not want to be involved. They didn't want to stay in real estate any longer. They wanted to get their interest out. And so what they wound up doing is they looked into doing a drop and swap. Now, we're way back in the 80s. They didn't contribute a tick interest. They didn't do any of that stuff. They just bought this property way back a long time ago. This is where long-term tax planning comes into play, right? From the very start, and how you want to do this stuff successfully from the beginning. So anyways, they immediately go contact attorneys when they're deciding to think about selling the property. They decided to do it in 2013, 2014. That's when they decided to start doing it. And so they decided that we want to sell this thing for $65 million, and they have conversations together as partners, and they say, all right, two of us want to do it. One of us doesn't want to. But even though we don't want to stay together in a partnership anymore, we want to get divorced from a partnership perspective. And so we want to go our separate ways. And so what they do is they now basically represent themselves from the start on selling the property, is what they ultimately want to wind up doing. So basically, Hadar, whenever he gets an LOI from someone, it's in his name. It's not in the partnership name. So someone's trying to purchase from him, not purchase from the partnership, right? So they start going down the legal trail and start going down all the items on like how things should be structured and what things should be done, talking about that. And so 90% of the documentation they have, I'd say 99%, doesn't even mention the partnership one time. The only time it did was on the settlement statement, where it mentioned the partnership and the three other partners. And then Hadar basically told the judge, look, this is a mistake. The partnership name was not meant to be on there, actually. There was a total mistake. Look at all other documentation, and the court found that they were a good judge of character, and they trust your testimony. They think you've done well. They'll believe you when you say stuff like that, right? So normally you might think, oh, one document might blow me up, but if you've got a pretty good case, you might be able to make it through. Anyways, that's the beginning of the drop and swap, right? So they don't sell till 2016. So they're starting 3 years in advance to get this thing done, right? They're taking offers, they're planning 3 years out. So they are soliciting offers, getting offers. They finally get an offer they like. And so they decide to go through with it in early 2016. Early 2016, they then distribute the interest out the same day they make the sale, February 1st, 2016. They created their LLCs beforehand. They each had their own individual LLC that they created. They distributed the properties out as tick interest to their LLCs. And then they were able to do immediately on the same day 1031 exchanges across the board. They'd already entered into contracts for various properties and whatnot. Like one of the partners did 3 properties, etc. And so they were ultimately able to go through these 1031 exchanges. And of course, New York didn't like that. New York had found many issues with it. They said this transaction is invalid. You didn't have a couple months of ownership like we were talking about earlier with Brandon. Therefore, this exchange is invalid. And Upwest is the one who actually did the 1031.
Okay. So where do they go from there? Like, or I guess before we go on, are you seeing anything wrong with this so far?
So the normal issue I would have with something like this is doing a drop and swap on the same day you make a sale can be problematic because the IRS will try and argue a step transaction. New York didn't actually make that argument, not at least what we saw here in the court in the court briefings. But the IRS probably try to argue step transaction doctrine, be like, hey, this is non-actual process, like this is just paper, right? You're just creating a paper trail. It's actually the other entity that made it happen. That's what the IRS will say. I would argue against that because we have other case law mentioned in this case called Magnuson and Bolker. And specifically in Magnuson, I think it's Magnuson, I get the two mixed up. It was a C corporation that distributed property out, liquidated itself, distributed property out to the single shareholder, and then he immediately did a 1031 exchange. And the IRS said, no, we don't believe that was an actual transaction. We'll step this through. And Magnuson actually, the court said, no, that's totally fine. He had business intent, even though he had a low holding period, didn't even hold it for a couple days even, immediately did 1031 exchange. They said, no, we approve of that. And that's 80s case law, actually. So it's been around for a while.
So they'll try to argue step transaction, but they're probably going to be unsuccessful. Do you think that's why New York just didn't argue it? Like, why wouldn't New York argue it?
Potentially. Yeah, I think potentially. I think the two main arguments that New York had here was they said you need to hold it for a couple of months. This is what they said. You should have held it for a couple of months. And the TIC never had the benefits and burdens of property, right? It never had true ownership. It was always the partnership or the individuals. So that's why they're saying it didn't work, right? And so that was their argument. And ultimately, those aren't great arguments because nowhere in 1031 is there a holding period requirement. And benefits and burdens of ownership, I mean, the whole time they treated the property as if they were owning it themselves, right? They went through 3 years of acting as if they had all done their own thing, right? So that's what's really interesting there.
Okay.
Real estate syndication tax is confusing to you. Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you'll be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed.
Yeah, I know there's no holding period requirement on the 1031s, and it's not surprising to see that, I guess in this case states, but the IRS, I know in the past, has tried to argue that there are holding period requirements, or at least tried to establish some case law around that to provide further guidance in the future as well. So I guess it doesn't surprise me that they tried to potentially go that route. But so what happened in the case? What happened next?
So basically, since now we've gotten through basically what they did, and now we went to New York. And so I've already kind of spoiled the case in the beginning is they win. And so I'm going to share this documentation. So if you're on YouTube, guess what? You get to see this. And so here's kind of what flowed through, right? So they had a very special documentation process they went through. So obviously we've got the individual owners in Up West Co, like we talked about earlier. And then we have the entity formation, right? So they went out and they all made their own LLCs that were going to own their TIC interest or we're going to own the TIC interest at the end of the day. Entered that sale contract, right? It wasn't, so I've said it incorrectly. They signed the contract back in 2015. And then they did the transaction, they distributed TIC interest and did the sale on the same day. And actually part of the reason they did that is for easier tax reporting, I think, so that you don't have to record any rental income or depreciation for that piece during that time frame. So it makes it easier from a tax reporting perspective by doing it on the same day, actually. So there is advantage to that. However, that's where the IRS and New York decided that they'd have issue, right? They did the drop, distributed property to 3 LLCs as a tenants in common, right? So now they've all got their TIC interest in that property. Everybody did their swap, right? Except the 2 partners did their swap. The other partners just decided to sell for other investments, like just wanted to invest in the S&P 500, et cetera. No cryptocurrency, unfortunately for them, probably. So they didn't get that big gain. But now they've got 3 different properties across the board. They wired the QI, do all of that, et cetera. So fantastic for them. They're all split up into different properties, et cetera. And of course, New York didn't like the same day transaction. That's what their issue was with. Like I said, like I mentioned a couple of times, that's what they didn't like. And so they're saying, hey, minimum couple of months is required. But like I mentioned a second ago with Magnuson, that's where like multiple times it was mentioned from the New York case is that like, hey, Magnuson and Bolker is not like, that's settled case law. We don't think that's really an issue here. Also, the other item on top of that was also the New York was looking at another drop and swap case that lost, that wound up being in the IRS's favor. And that one's called Chase. And like, we'll keep diving into these tax court cases because like I actually think they're relevant and helpful information for everybody. In Chase, it was a totally separate fact pattern than this one, right? Everyone here acted individually. Everyone here kind of did their own thing. They split commission fees. They split qualified intermediary. Like, well, they didn't split qualified intermediary fees, but they all paid on their own, right? They did all this stuff on their own. While in Chase, one GP didn't tell the other partners that they wanted to do it, didn't put it in their operating agreement, didn't do any of the paperwork, honestly, and just kind of said, oh, yeah, we're just going to do this tick, but we're not going to do any of the paperwork or any of the intents required under it. And so they said, oh, hey, 46% we get, and we get to do 1031. And of course, they didn't do anything like this group did, and they lost. And that's what New York was comparing against, and that's what the New York auditors are comparing against. And that's why the New York tax court decided no, we don't know if we agree with that because look at all these fact patterns here that exist for them that didn't exist for Chase.
Okay. So New York's trying to argue that there is a hold period requirement. They're arguing that there's not a hold period requirement. You kind of already spoiled the ending, but why were they successful in arguing that they didn't have to have a hold period? And how does that impact future cases? And I know this is like a local to New York type of case, but people that are outside of New York, how could they potentially use this as leverage in their own arguments?
I think it's perfect case law. I think it's perfect case law argument that you'd want to make and have on file, try to follow a similar structure as they did here, right? And that way if you wanted to go your own separate ways, have the people who want to do that, who are willing to, if you can do the tick, follow this exact structure, represent their own interest, represent all that stuff, right? Hard to do when you don't have everybody that wants to go their own separate ways. That's a problem with syndications, is that there's a lot of mouths to feed, a lot of mouths at the table that you have to get a say in what happens ultimately. And so all you need is one person to say, nah, I don't want to do this. And that creates problems. You can mitigate those in some ways, maybe with special allocations potentially. Another episode we'll be having, but it's possible. But what I would say is why they not care about the holding period? Because there's no holding period requirement in 1031. There's nothing that says in 1031. All they ask is this for trade or business or investment purposes? As long as you try and honor that intent at the end of the day, you're probably going to be good to go ultimately.
Got it. Okay. What else is a big takeaway from this case?
Another big takeaway I would say is that, so we talked about that. So in Bolker, so Bolker is the intent case, right? And then what I would say the biggest takeaways here that we can make ultimately is that even if you have a same day transaction, that doesn't mean the end of the world, right? So that gives the people who didn't necessarily plan early enough on, and look, these people planned 3 years in advance. They got all their ducks in a row together. They said, hey, we want to all sell the property. We don't want to be together. We've heard of drop and swaps. Let's go talk to some attorneys and have them help us structure the deal and have that get taken care of, which they did, right? And so even though they were they created these entities, not really, they created them basically a month before the tick interest was actually distributed, they still were able to win in New York. Now, is the IRS going to have different takes? Maybe. I don't know. But I know New York, there are two state agencies that I don't want my clients to get audit letters from. It's the FTB out in California, and it's the New York State Agency, right? Those are the two places I don't want because they know their stuff and they're good at what they do. And they were basically defeated in this case. And so what's really interesting about the case is that it didn't reference any New York state law. It just referenced everything that's federal. So we've got really good guidance and good case law that we can use to defend these types of situations, right? If we can have longer hold periods for people and that's not going to create an issue or be a problem, fantastic, right? We don't have to worry about the IRS coming after us for that. But a lot of times business intent comes into play. Someone wants to make a transaction, do the 1031, execute it faster rather than later. That's a great opportunity. And we've got something that we can use or information we can use to substantiate this going forward.
Okay, so the big thing that they did right was that they decided that this is what they wanted to do well in advance of the actual transaction. They looped in appropriate counsel and started making the right moves to get this all structured in the right way. And now there is some case law that can help anybody else that's looking to do a drop and swap in the future. Now, was there anything that they did wrong or anything that they should have done differently?
So honestly, this is about as good as you can get, in my opinion, because they transferred title. They did everything appropriately from that perspective, even though it was really short. They actually went through all the legal steps. So they had the correct paper trail to show who had ownership, when they had ownership, and they went through the contract and didn't list the partnership basically anywhere. They had a strong case and they had really good legal work, in my opinion. I don't think, like, in my opinion, I don't know there's anywhere they can, if you, like, I guess the only thing I would say is not doing it on the same day. That would be the only possible caution that I'd advise out there. But clearly the tax court didn't have an issue with it back in the 80s, and New York didn't have an issue with it either. As long as things, what I like to say, substance over form type of thing, is if you are following the letter of the law appropriately, and if you look underneath the paperwork and you see substantively that that's how everybody acted and that's how everybody ran their business essentially, then yeah, you can defeat this in an audit, which is why they took it to court and were able to win.
So if you don't do it on the same day, like what should the timing look like? Is there any guidance?
This is where you get a lot of mixed guidance from CPAs. Some people say you should hold it for a year, for 2 years, etc.
It's a long time to do a drop.
I don't even know if
like drop swaps are meant to be, they're designed at least. I mean, I get that that's like the safe route. Don't get me wrong, and it's probably actually good advice, technically speaking, but I just don't know if it's practical. And that's where I kind of like lose the respect for that type of advice, because it's just like, sure, yeah, we would love to hold this for 2 years, but it's just not practical. When you're talking about a drop and swap type, the reason that you deploy a drop and swap is because some of the partners or all of the partners want to go their separate ways, right? Otherwise, you would just 1031 exchange inside of the entity itself. So when you get to that point of deciding you want to go separate ways, are you really going to stick around for another 12 to 24 months? Probably not, right? So
no,
it's just not practical. I mean, how do you balance that?
I mean, I personally think that, like, just if you follow the rules like they did here, I think a same day is fine, right? And I said the same day, it's just like when you report that on the 8824, it's going to see that same day, like basically like they look into it, they're going to see that same day transaction, right? They're going to see when you got title to it, and they're going to see, oh, wow, that's the same day 1031. They might want to investigate that. So that could cause potential problems at the end of the day. Now, as long as you got all this fact pattern coming up, right? We haven't had a whole lot of drop and swap cases in a long time. I wonder why. Probably because they get to appeals. They talk to the sure, you go through the auditing process. Maybe the manager disagrees. Maybe the agent disagrees, and then you get to appeals. And you mentioned all these cases to appeals, and they go, yeah, we agree, and they move along. That's why you never get to tax court, because there's no argument to be had. Now there are drop and swap cases that do exist, right? Like I mentioned with Chase, but that's a fact pattern that does not follow the way you should do a Volcker transaction or a Magnuson, right? They didn't follow to the letter of the law in the way that they're laid out in this Hedar case.
Interesting. Are there any gotchas that they did a really good job getting around or handling? Because I'm just trying to help people understand, like, okay, these guys did a good job. They did the right steps up front, but maybe it was just getting really qualified attorneys and accountants to help them structure it all. But was there anything that you were kind of expecting them to lose on that they ended up winning on?
When I read the same day transaction, I thought they would get stepped out of this, is what I thought would wind up happening. And so, like, the step transaction, right? I don't know if I explained it earlier. Basically, the IRS looks at the ultimate result. They don't look at the in-between. They look at how you started and how you finished. And they said, sounds like that the in-between steps were just unnecessary, unless you can prove business intent for that. And so they were able to prove plenty of business intent, right? So if you lay that out beforehand, you have two partners. Hey, like, yeah, we want to do real estate, but we're kind of tired of like being in the same property together. So we want to go our own ways and get smaller properties. We don't have this massive multiplex in the middle of New York any longer that neither of us get to manage, has tons of maintenance and renovation fees. We also we want to own a Dollar General, right? That kills on cash flow. And like, I just want to own it 100%. I don't want to have so many cooks in the kitchen type of thing. And so documenting that information early and onset and changing your operating agreement, right? I expected them to mess up the operating agreement, but they changed it. Now they added a 1031 clause for people to be able to win at. So just another example, like this top to bottom was a really, really good way to run a drop and swap, and is good advice for those who are looking to do this in the future.
So in terms of, you mentioned the 1031 clause, in terms of that 1031 clause, what could sponsors or just general partners of either large or small partnerships be thinking about in terms of a 1031 clause being added to their operating agreement? Like what does good look like? What does not good look like? Help us understand that. Because obviously we would like to be able to think about all of the ways that we could exit this partnership. And interestingly, I think that the attorneys, at least that, the operating agreements that we see, I think the attorneys always do a good job of thinking about death and disability and like these crazy events, but I don't see many addressing a 1031 exchange specifically, but that's probably a great exit event if you could like plan for that. So what could a good 1031 clause look like in an operating agreement?
Yeah, I mean, just having one, right? Just like most operating agreements don't even have a 1031 clause to allow the flexibility to have this happen. A good 1031 clause probably looks like just stating is that like, hey, in the interest of the partnership, we will allow 1031 exchanges to occur for partners who are willing to participate, or even adding something about special allocations of gain. That's what you'd want to see in there, because let's say we can't do the drop-in swap, right? We got people saying, no, I want to get cashed out. I don't want to go through the exchange process, or I don't even want to let you distribute and take interest to me. I don't want to mess with all that. Sorry, just pay me out what I would if we sold today, right? And so in that instance, we'll have an episode on this, but you'd want to specially allocate gain to that person as it follows the cash, right? Like Matt and I talked about talking about following substantial economic effect. And so to do that, that gain has to go to that partner when they ultimately sell at the end of the day. So you want to have language in there that caveats for that and prepares for it, right? The way I like to think about partnerships ultimately is you want to think about it, how is this going to blow up, right? That's what you want to think about. Let's say operating agreements are disoperating agreements, essentially. So like it lines out what happens when all this blows up at the end of the day.
Got it. Okay. Are there any other big takeaways from this case or just drop-in swaps in general that you want to leave people with?
Ultimately, I think it's just like, don't be afraid of 1031s when they have a short hold period. That's like ultimately, that's my big message out there. Is like, don't be afraid of that. I know we see lots of different things online talking about you got to hold for a few years or you need to do this. Don't be afraid of it, right? And so maybe that means the IRS comes and knocks on your door. As long as you've got good representation, you've got good fact patterns with you, you're going to be fine.
And bad fact patterns can absolutely be like, we have zero interest in being real estate investors, or we have zero interest. Like I've actually seen, I think it was either a tax court case. I think it was a tax court case, but there are examples where people will 1031 out into call it like a beach home or a mountain home that they're going to use as a short-term rental and investment property that they absolutely intend to move into, but they don't show that on their returns. They just say it's going to be an investment property, or that's the intent that they want the IRS to believe. But the bad fact patterns are when, your emails get pulled and your text messages and it's all like, I can't wait to move into this, in 1 year after, so to Nate's point, make sure you have good fact patterns, but good fact patterns also mean being very careful about what you say, what you write, because that could all be pulled back up in court at some later point to prove whatever argument the tax authorities want to prove. So it's just something to think about as you're going through this as well. It's not like, after hearing you explain this, I get from this case that they were being very genuine and wanting to 1031 out and continue their real estate investing. They just wanted to do it separately. And so this was a good solution for them. But again, this does not mean that you can do the same thing and not be genuine. So the best piece of advice is just don't let the tax tail wag the dog. Do what you need to do for your business, your real estate, and then figure out how to layer the tax on. Don't let tax drive your decision making, because if you do, your fact patterns will not be good. They will not align with what you're showing, the intent, and that'll get blown up.
100%, Brandon. I couldn't put it any better. And after you've heard all this stuff and you're like, wow, I didn't know, like my CPA's told me for years, I can't do a 1031. Heard those types of things, right? Check out the comments below and the links below. Contact me at nathan.sosa@hallcpa.com if you want to work with us and talk about doing these types of transactions. We'd love to work with you and talk with you, review an operating agreement if you've got something on there that like, hey, is this going to be good enough for a 1031 clause if I want to go through this transaction, right? We'd love to help you and work on that.
Awesome, Nate. Well, great job breaking the case down. Thanks everybody for listening.
All right, talk soon, everyone.